All right, welcome back, everyone. We are delighted to welcome co-founder and CEO of Innova Resource Group, Chris Grizafi. In this session, Chris will cover why black is the new gold and outline why you should add oil and its substantial tax benefits to your portfolio for the next 20 years. Chris, thanks for joining us today.
I appreciate it, Mark. Thanks for everybody being here, and thanks to the Money Show for having us on. Hopefully we'll some of you folks were probably on Elliot's call there before this in his presentation. There's definitely several things that I agree with him on. I hope to give you a different perspective. We're actually an independent oil and gas group in Texas, and we started our company in 2007. I've been in the business since 2001, so we've been through some cycles similar to this, some down cycles. The one in 08, 09, I do think it is different than this one. But through our experience, we've seen it from an inside kind of information of how these things play out and what really happens in the oil patch and how to get deals done and how to make money through that. As we have a down cycle moving up, and that's my presentation today, to show you how to directly invest in this cycle. So we have our disclaimer, all the stuff our attorneys want to have. Now today's agenda, we're going to go through oil, Economics 101. It's simply what it is. We're going to go through a short-term outlook and where we think we're headed over, say, the next 12 months. The global oil boom, why we want to be long for oil in the next 10 to 20 years. These investments are a little bit higher risk, but should come with high reward. And you can take advantage of the direct investment in oil, a lot of tax benefits. Some of the money that you're going to be sending to Uncle Sam, you could actually divert, and also cover, IRG, who we are, our track record, how to invest directly with owners in the wells, and our strategic plan to capitalize on the future rise in oil. So first, oil really is simply just Economics 101, supply and demand. And as was mentioned earlier, the 08-09 cycle was a demand type of bust, and this really is supply. Over the last 4 or 5 years, in the United States at least, oil was over $80 a barrel. And of course we went to 100, but really we started to see the shale plays boom and become very economic as we were over 80. And throughout those 4 years, we added 1 million barrels a day per year. So that was very, very impressive. I did not see any kind of production increases around the world like that. That is just the American ingenuity at its best. That, of course, caused, with prices being over 100 around the globe, everybody to explore and pump as much as they could. And right now, a few graphs here in a second are going to show the EIA and some organizations like that say that we're about 2 million barrels oversupplied. It's really, really, really hard on a daily basis to tell you right now what the global production is and demand. There's a lot of speculation in those numbers. I believe we're probably in the 1.3 to 1.5 million oversupplied because we've seen enormous demand response with lower prices. In fact, we initially, with high oil prices sustained over that period of time, we saw unbelievable demand destruction in the United States. We were at all-time lows on the amount of gasoline that we were using with $100. $3.50, $4.50, $5, a gallon of gas was really causing some pain, and people started to actually look for alternative energy supplies, electric cars, solar, wind, things like that. But right now we're looking at the supply on the global market probably in the 96 million barrel a day range. And that consists of OPEC. They're producing all out right now, but about 30 million barrels a day. And really, if we look back to the 2006 to 2008, you'll see the Saudis, the main producer there in OPEC, third of that production, they were ramping up their production to about 10 million barrels a day. They're a little bit over that right now, but throughout that period, they really didn't like producing at those high rates. They said, it's really causes a lot of issues with our long-term reserves and the stress on that. And so once the crash happened in that 08-09 period, they simply took a couple million barrels off the market. They're about 8. They really liked that better. As they've pushed for control of their market share right now, they are back to over 10 million barrels a day, and that is really all that they have. Now the USA, we're with shale coming along and ramped up. We were probably in the 9.5 to 9.6 million barrels a day, and right now we're about 9.3, and that's just this past week. A couple days ago, we drained down some of our reserves to about 4.2 million barrels last week. So that's pointing to demand here being extremely high. And we also saw, and this is really hard to, it's estimates. And, they kind of take the average of all the shale plays, and they don't know exactly what's being reported. They're usually a couple months behind on production reports, that is. So right now I can only see what's been produced in the Permian, for instance, probably like April kind of production. But estimates at about 100,000 barrel a day decrease in our overall production. And what that is signaling is we're starting finally to see the hyperbolic decline curves of these shale wells come into play. And what's kind of set this up and why our production actually continued to rise throughout this year is a lot of these companies that were in the shale plays had hedged their production. Some of them were still hedged out. And so throughout the first half of this year, they continued to drill. And so we still saw some increase in our production when we were still down at $47 a barrel. And you're kind of going, what's going on here? Why are they still drilling? They weren't getting that price. They're probably getting the $65 to $75 range because they were very good at hedging out all their production. Now you're starting to see some of those hedges come off and the drilling to actually slow down. We only have about 800 rigs running, and the way we were being able to increase that million barrel a day over 4 years to a total 4 million in that time frame was by running over 1,600 rigs at a time. So this is cut down considerably and starting the hyperbolic decline curves, which is, once you drill a shale well, and in my company in particular, about 3 years ago, we changed our strategic focus as a smaller independent to move away from the very expensive, capital-intensive, unconventional shale drilling. We started developing a field in the Permian in 2008. It's drilled over. We were drilling a couple wells a month at the start of it for 2 or 3 years, and we were hitting unbelievable wells. And the hyperbolic part of that decline curve is they come in very, very strong, and within a year you're looking at 70 to 90% declines. So we had a well did 1,000 barrels a day, and within a year it was doing about 80. And within 2 years, it was doing about 25 barrels. So this is happening throughout the shale play, and the wells that started 4 years ago and the wells that started 12 months ago, we're starting to finally see that. And you cannot keep up with those decline curves unless you're drilling wells, and that's the only way you can increase. You have to have 1,600 rigs running at a time to increase like we were. We don't have that, so we're going to start seeing probably 100 to 200,000 barrels a day come off of our daily production. And I think by the end of the year, going into the first quarter of 2016, we could easily see 500,000. The only thing we can't gauge is the who's drilling. And of course, too, when you're dealing with lower oil prices, you're going to drill your best spots, your most economic spots that are out there. So you're going to have your best wells. And a lot of these fields out here, the technology has been done over the last 4 years, and they really have been able to increase their reserves and the performance of the wells. It's been very, very impressive. But I do think we're going to see about 500,000 barrels a day off the market, at least by this time next year, especially with the strip and the hedges that are going out now. We're starting to see those come down. So people are not able to hedge their oil production at 70, 50, 55, and that's just not very economic. We're not drilling in the Permian any longer because it is not economic. It's very, very capital intensive. And in fact, just 2 days ago, I heard that the rig count specifically in the Eagle Ford Shale, and we've been in the Permian, we've had stuff in the Eagle Ford. The Eagle Ford is the most economic shale play out there, period. You get really good prices for your oil. You have great transportation heading out, and there's a lot of service companies, and that finally went down below 100 rigs in the Permian. That's the first time it's been below 100 since 2011. So I think we're going to start seeing a lot of a decrease in the drilling and the hyperbolic decline curves kick in. What also is made up of the 94, 96 million barrels a day that we're producing globally is Russia, Brazil, Argentina, all the other producers that make up that 50, 55 million barrels a day. Those fields are mostly older fields, and a lot of these countries are not being capital efficient and putting the amount of money that they need to put in to keep up with the older wells and drill new wells. So you're going to just see natural declines in their fields of 2 to 5%. And on 55 million, you're talking about 1.5 million to 3 million barrels coming off the market over the next 12 to 18 months, and all the other countries that are producing oil. And lastly, Iran. Yes, the sanctions have been off, but you know, they're coming off. And really what a lot of people didn't know is they were still able to supply and export oil to a group of countries. And so before the sanctions hit them, they were doing about 2.5 million barrels a day. And since then, they've been running anywhere from 1.2 to 1.5 million barrels a day. Those numbers are coming from the IEA, and I don't know how true they are or not, but they're still producing over 1.5 million barrels a day. And to get back to 2.5 million in 4 to 5 years, being in the business, being an operator, running wells, you can't just turn that spigot on and add 500,000 million barrels like that. I think they're going to be lucky to get 500,000 in the next 12 months, but I do think they can. It's definitely not going to happen in the next 6 months, but that's something to watch. I'm really not looking, on a supply and demand side of things right now of soaring back to $80. Not at all. But I do think probably the 50 to 65 range is something that we could be trading in the next 12 months. Now, this is a little bit more what I've talked about from the EIA, and we're looking right now, and you can see, and right the dotted line there is where we're at today, and the green bars represent these barrels in storage that we have. So obviously over the last year or so, we've been putting a lot in storage. Clearly the black line, there's the consumption. Blue is the production. We were definitely a couple million barrels, maybe 3 at some time, over what we're actually consuming globally. And right now, if you can see there's towards the end of this year, they're projecting a sharp decline in current production. And I assume that's mainly from the shale. It's got to be. And you're going to see the black line get a little bit closer, because what I think a lot of folks are I mean, it's not the popular thing to talk about demand and how it's increasing right now. It's a bearish market and how much oversupplied we are, et cetera. But the United States and China and other areas, developing areas, are increasing their demand a great deal. I believe the SUV sales in China over the last year are up 58% over the last year, and so everybody's really enjoying participating in the global GDP and acting like an American and using a lot of petrol. Now, as I touched on demand increasing, I believe that we've added probably about 1 million barrels a day of increased demand just in the United States. And this is not going to show up till probably mid-16, but this chart is showing the amount of miles traveled, and we're at an all-time high this year in miles traveled. I don't know about everybody else, but here in Texas, we actually, in the first part of this year, really enjoyed having about $1.95 a gallon. It was awesome. It's about $2.50 a gallon right now and going down again. So the demand is extremely strong here and in other areas, and that's something that I think the professionals forecasting what they think it's going to be, they're going to be way off. Now, this is a study by Exxon, 2015, and they're projecting significant demand growth through 2040. This is in BTUs, and you can see China is obviously a big part of it, India, and the rest of the world. Now, that's kind of a short-term outlook. I don't see $60 tomorrow. Within a year, 60, 65 is definitely doable with a very strong demand this short term and some of the declines that I spoke of. But while we're long on oil over the next 10 to 20 years, I mean, just let's face it, the world runs on energy, and fossil fuels are the only viable economic model right now. You know, per unit of energy that you get out of hydrocarbons, and the cost is not matched by any other technology out there, period. And with prices in oil going down so much, it's not causing other people to look for other ways to gather their energy, and a lot of money is being pulled away from wind and solar, et cetera, et cetera. So fossil fuels are here to stay for a while. Just heard that $200 million in new developments by the majors were just shelved, and they estimate about $20 billion in oil reserves. What that means is the offshore big platforms, it's extremely expensive, and it takes years to develop and drill. And after they have some success, then they have to think about getting it to market. And these projects are anywhere from 7 to 10 years in the development and drilling phase by the time they start before we start seeing any oil hit the market. So this is major. This means that these guys pulled it off, and we have to see 70, 75, 80. I'm not sure. The economics, it's got to work for those guys to put this back on and in play. And then you're going to have a lag time of 7 to 10 years. So we're at least 15 to 20 years out before some of these projects hit the market. So there's going to be a time in the next 5, 10 years that we're going to have demand soaring, and we're going to outpace supply, and it's a tight market, and we're back up to $100 a barrel, and we're going to see this whole thing replayed. Is that happening in the next couple of years? No, and I'm excited about that. This is when guys like us are able to make a lot of money and capitalize on these price swings. Now, IEA estimates by 2020 100 million barrels a day of demand. That's a strong number. We're at 94 probably right now, maybe creeping up to 95. We're 96 million in production. There's got to be some oil to come onto the market to bridge that gap. We're seeing $150 to $200 a barrel oil. That's not going to happen. And let me do a little history here. In 85 to 2015, and this has been compared to 1985 crash. I think it's very different than that time because we were globally using 60 million barrels a day, and we've increased 34 million barrels a day. And during that time, during those last 30 years, the United States only accounts for 5 million barrels a day added. So we have over 30 million barrels a day coming from other areas like China, India, et cetera, et cetera. Now, speaking of China, they've gone from 1.8 million in 1985 to over 11 million barrels a day. And that's just what kind of people guesstimate is their demand right now. It's really hard to get accurate numbers out of China, but I guarantee you it's 11 million strong right now. And one reason is they have more licensed drivers than the United States has population, and they're in the process of shifting to a consumer-driven economy. So if you think about that, the United States has 66% of our population licensed to drive, and 200 and something million drivers, and China has 1.4 billion people with a B. So if they're going for the 66% number, they've got to more than double the amount of drivers that they have in China. So I easily see China surpassing the United States in oil demand. Is that in 10 years? I don't think so. Is that in 20 years? Probably so. And another outlier that a lot of the speculators from a global perspective have their eye on is India. They've really been lagging their development from China, but they have a very similar sized population as China, and they have a ton of room for growth. They're starting to see a similar pattern from 85 to 2015. You saw, China go from 1.8 million barrels a day to, in 10 years, they were at about 3.5 million barrels, and over the next 5, they're 4.8 and 6.8, all the way to over 11. And if India is even just half that, they're going to be in the 7 to 8 million barrel range today. Obviously, I love numbers, but I know a lot of folks like pictures, and a picture can tell 1,000 words. And this is the population in 1970, almost 4 billion people, and energy demand will get brighter. Looked it up today on 2015 world population, and we're about 7.3 billion people. Now, taking advantage of the U.S. oil boom and why it's your best investment, and just a little bit about, there's a lot of experts that think the United States, trapped under many of our basins and shales, have massive amount of reserves, more than Saudi Arabia. And most of this technology has come from offshore oil. All the seismic, all the drilling and fracking techniques has been developed for years and years and years in the ocean. Now it's come onshore and allowed us to unlock millions of barrels a day. Back to just some China's up, India's around 3 million, and again, the IEA is looking at 100 million barrels a day. So right now, we're going to need 6 million more barrels a day, and that's just in a short 5 years. Where are those going to come from? Like I said, the majors have shelved projects. The OPEC folks are producing all out, and they are not putting money back into their projects, into new development. They're just not doing it. Saw last week the Saudis just issued a bunch of bonds because of the lower oil prices that they're getting. The revenues are down. They support a lot of their population and their society through those revenues, and they've had to issue bonds because they tapped into their cash reserves. So a lot of these folks of Venezuela, Brazil, the quality of work and oil and gas experienced folks that they have just are not going to be able to increase their production in massive amounts. 6 million barrels is a lot. Well, we did 4 million barrels a day in 4 years. So we're really the new swing producer, and you're going to have those times where we go up and down. But a lot of the basins, the Eagle Ford is one of them, the Niobrara, the Bakken so-so. It gets really hurt by transportation costs. They get nicked $10, $15 a barrel to get their oil out of there. So there's a variance. Oklahoma, Scoop Play, and all through Texas, we have great markets to get our oil to the refiners and get top dollar for it. And it's economic at $60, $65 a barrel. So once we start seeing prices ramp up to that level, you'll see our production start to head back up a little bit. But there's a great opportunity to fill the void in that demand that should soar to over 100 million barrels a day. And a lot of it's going to be from the United States. And the reason why I spoke earlier of the offshore, technology, this is really driven it. You would be unbelievably amazed at some of the logging, and which is basically what you do. You put tools down the hole after you drill the hole, and it tells you where the oil is, tells you where fractures is. You can literally see some of the fracturing systems that are in the rock, and you can specifically target those. It's amazing what technology has brought to the oil field here in the United States. We've been involved in many of them that have been fracked in the Permian Basin. We've done a lot out there, and we haven't had any dry holes. We've had some mechanical failures from a standpoint of wells being fracked incorrectly, blowing up some casing. I mean, things do happen in the oil field, and it's very expensive. But the dry hole with the shale guys is somewhat a thing of the past. It's whether you're going to have a great well, a good well, or one that's just not going to pay out. But a little on the technology side, this slide is just showing you what's going on. And in this particular well bore, what all of these shale wells are doing are going down and then going horizontally. And they'll connect all the fractures at the bottom, and then they force water, a few chemicals, and a lot of sand, and at very extreme high pressures that open up these fractures and shove the water and sand into the fractures. The sand goes in and props open the fractures and allows the oil and gas to flow to the wellbore and up the hole. What's happening now is very similar to what happens on offshore. You have one offshore rig that may drill, offshore may drill 40, 50 wells from that one platform. Here you're seeing, the most I've seen is 8 wells drilled from one station, and the Eagle Ford and Bakken and things of that nature. That helps them save a little bit on the cost of it, but it's still a very, very expensive and capital intensive program, which is why I'm not real hot on any kind of oil and gas stocks right now, any of those players. It's going to be really hard for them to make some money in these times because it is so capital intensive. But this gives you a good idea of what we're doing. And what we're offering today is availability to invest directly in one of those wells that I just showed you. Black's the new gold. It provides a little bit of a hedge. It's tangible. What it allows the private individuals directly participate in the drilling, completion of wells. You purchase fractional ownership interest in them. The oil's physically in the ground. Investors have titled ownership to their piece of it, very similar to real estate. Like I said, it's a tangible hard asset, and a lot of times offers possibility for income over a very long period of time. And this goes up and down with the oil prices. Now, some of these wells can last 20, 30 years. Now, in year 30, is it producing 100 barrels? Of course not, but it's still producing some income, and hopefully after you've paid off that investment and recoup your initial investment, it's going to provide the income for you, mailbox money, for quite a while. This is not for every investor. There is a high degree of risk involved. We have, like I said, we do have dry holes. You do have mechanical failures. Not everything works in the oil business, but at times you have a chance for a very high reward too. One thing that has changed the way these investments are treated, it's always been very illiquid. You own a piece of an oil well, and you're just going to be stuck with it for a while. But with the internet, there's been some things that have evolved, like energynet.com, and you will have physical ownership of your interest, and to be a working interest. You can also own mineral rights, etc. And these can be openly traded on an auction-style format on EnergyNet. So it's really allowed for some different dynamics to come into play and make this a really intriguing investment. How you invest? It's a private accredited investor and invest directly with our company, and you invest in the cost of the exploration, the drilling, completion, and in all the production processes at a turnkey fixed price. And just to give you an example of how that works and how we're involved and how we make our money too, is we're not interested in marketing it up, make commissions or anything like that. We don't do that. We're interested in drilling wells and building wealth through oil and gas. And so we'll offer, for easy numbers, we'll offer a price of $100 per investment, for instance, and we'll turnkey that. That's fixed. There's no more investment, just $100. And our goal is to drill it for 75. And that 25 bucks is our profit that we invest in the wells. So we're always the largest investor in every well that we do. This just allows us to, instead of drilling one well with our money, to drill 12 wells and spread out our risk. And that's what we preach to every one of our clients, is to take a piece of mostly everything that we do, spread out your risk, and build a portfolio of oil wells and income coming in. And that's really how a lot of oil companies do, even the majors. You'll see them in the offshore stuff. There'll be 4 different majors involved in one big platform. It just allows them to share a portion of the profit in exchange for that upfront funding and diversify their risk. These are for accredited investors only. It's offered through Reg D offerings. $200,000 annual income or $1 million net worth is the definition of accredited investor. And we offer these directly through ourselves. We're owners and operators, so we physically are out in the field operating the wells and managing that cash flow and the maintenance, et cetera, of the well bores. We do not have brokers or commissions involved. A little bit about my history and my partner in this. I got in as a stockbroker in 1997 after the crash of and 9/11 happened. There were a bunch of layoffs. I was looking for other areas with my securities licenses, and a good friend of mine is a petroleum engineer, said you need to get into the oil business. And the only way I knew to this is go through broker dealers. So they're traditionally a bunch of broker dealers that offer alternative types of investment like this, private investments, and many of them offer oil and gas. So I went and I managed a couple of firms and learned the whole process of the oil business from the finance side of it. I learned real quick that the cards are stacked against the individual investor in these particular situations when you're dealing with a broker dealer. And everybody's got to make money and do what they do, but kind of lifting the skirt up of that part of the business is, if we charge $100, turnkey it, and do that, most of the BDs, they charge probably $300 to $400. And the reason why they have to mark it up so much is they have to pay a lot of regulatory costs. They have to pay commissions to brokers. It's a whole other dynamic that's extremely expensive. And the only way an investor's gonna make out on that real nicely is they have to hit a barn burner. And the Jobs Act that Obama put into place has really opened up our business to allow guys like ourselves, direct owners of companies, to allow investors to come directly to us. We're not paying any commissions ourselves or anything like that. You're able to invest right alongside of us and reap the benefits just like we do. These investments, like I said earlier, can pay for long periods of time. They pay the monthly income, and it fluctuates with oil and gas prices. Right now, what we're seeing, and this is what happened the last time in the 08-09 period, but what we saw is prices come down considerably, oil and gas prices that is, and it's about a 6-month lag time for service companies and their prices to drop. And that's kind of funny, learning in this business, and that's the benefit of coming on board with us, is you're going to get to know, the inside scoop and how it really works. And, those service providers, their prices go up when oil prices go up. and they go up quite a bit. And that was one reason why we decided to pull out of any shale play and shift our focus over the last 3 years to strictly shallow oil, because the prices were just ridiculous. Now, we haven't seen the service prices come down as much because people have still been drilling wells. And, you know, the big guys, the Devons, the XTOs, and those folks kind of throw around their weight, and they can negotiate a little bit lower. So we've, from here on out, we have some new developments that we're doing. And we are focusing on some shallow areas that the majors and all those guys have been drilling deep and trying to find deep gas and deep oil and fracking and all this kind of stuff. You know, they're publicly traded. They have some different ways that they can book those reserves and pump up their stock prices and all that good stuff. Those days are over for now. But what it really did is it left a void. It left a void in the market for shallow oil. They ran from shallow. So a lot of times we're able to pick up leases and just lease, you know, to 3,000, 4,000 feet. You know, in this particular area is in East Texas. We have about 20 miles of a trend, and we're currently, we've got about 2,000 acres leased up, and we're leasing more. And there's a bunch of gas and things like that, the Haynesville Shale and some other plays that you might have heard of that are underneath what we're doing. And they've ignored all the shallow stuff. We're going into areas that, and Elliot spoke to this a little bit, in the 70s you had a big boom, just as you did in this last 5 years of exploration in the United States. And so this particular area, there's about 30 wells drilled in our little trend that we're focusing on. And they were just traditional ways. You drill a well, you perforate your pipe in the zone that you want, and you throw some acid on it and put a pump jack, and away you go. We're going to move in. It's a zone that you can frack, so you can use new technology from a fracking standpoint, where we can improve the amount of reserves that you can recover and the amount of production that you're going to get initially. You'll still have a similar decline curve as a shale play may be, but you're talking a lot less expensive. And a lot of these shale wells, they're going to need 200, 500,000 barrels in recoverable reserves to just break even on what they invested in drilling a well. And this particular area, we need about 10,000 barrels of well bore to make it economic. And what I have here on the screen is an example of a well in our field that's very close by us that was drilled in 76. And these are monthly production totals of barrels a month. So it started out about half a month, 1,000 barrels, 2,500, 2,500, and you see a little bit of decline. But it produced over 12,000 barrels in the first 7 months, 6.5 months. And that well would have paid out, but a very good investment. It then continued to produce another 12,000 over the next year, and then within about 31 months, produced over 30,000 barrels of oil. And on the far right column there, you have the per unit, and what we do is we offer our investments as a unit investment in a program, and our current offering in this area that we're about to start in the next 30 days is the 2-well package. But this is just one well, a 3.5% ownership in it would have given $62,000 in income over that 31-month time frame, and that's at $60. I put this together for the money show about 3 weeks ago, and believe it or not, 3 to 4 weeks ago we were about $60 a barrel, and now we're at 48. So it's volatile right now. It definitely is, but I like I said, I see us moving back to that $60 range in the near future. Black is the new gold. I spoke about it earlier. It provides the commodities typically a rise against inflation. You have a little hedge here. I know the dollar has been on a tear over the last 12 months and increasing quite a bit, but I think myself, along with several others, probably see some inflation coming in sometime, definitely over the next couple of years. Oil prices will then go up, et cetera, et cetera. And the whole, idea is to be able to go out in the area that we're doing and take advantage of lower exploration prices that we're starting to see kick in, so you can make these wells economic at these prices because it's not expensive. It's not expensive at all. And on top of that, you're going to have some serious tax advantages that come along with it. A lot of people don't know. All the people that are drilling wells in the United States, all the companies receive these same tax benefits. Unless you really dive into the reports, you're not going to see it. But 15% of the income is tax-free. Now, another part is the initial investment. The initial investment in this example is $50,000. Eventually, 100% of that can be deducted against any form of income, active, passive, capital gains, you name it, any form of income. The majority of that 100% is taken in the first year, 80, 90% of it. And it's a direct write-off to any kind of income. So in the example there, $50,000 at a 43% tax bracket, that's 35 federal, 1.5 Medicare, 6% state tax. You're talking about $21,500 in total tax savings. That's real dollars that you will not be sending to Uncle Sam. We have a lot of first-time investors that call us after their April powwow with their tax guy and said, "Man, you weren't kidding." It's just something that's not really seen till that time you go to write the check. You don't have to. So it causes you to have about a 28.5 net out-of-pocket investment. And then again, 15% of the income is tax-free through the depletion allowance. Our management here, myself, I gave a little bit about myself, and I'm more of the finance individual, deal with putting together the AFEs. Paul Hallenquist is my business partner. We started this company in 2007. He's chief operations officer, and then we have Charles Hopkins as our geologist. And together we have over 50 years of combined experience in the oil and gas business. Charles started out with Gulf Oil in Midland, Texas, and very interesting over the start of Drilling Info, which is a tech company that started in the 90s and is focused on allowing us to have access to a lot of unbelievable products, and including a lot of research and information on production and areas where we'll go to them to research older wells and find out plays that we can go capitalize on. He actually was with them and starting them out. Very, very, very knowledgeable in all the shale and different types of shallow plays that are out there. So, and just wrapping this up, kind of come up on my time here. There's our contact information, our phone number, and email me at Chris@Anovo Resources. But Mark, I'd like to open it up to any questions if anybody has any. That's pretty much all for my presentation.
All right, thanks so much, Chris. Again, for anyone logged on, we do have about a minute or so remaining. If you have any questions, we haven't had any typed in just yet, Chris, but if there are any questions, please feel free to type those in. We'll relay those along and get those answered as soon as we can. And while we're waiting for some questions to come in, this presentation will be made available on demand in the virtual e-show. So if you missed anything along the way, or if you just want reference to Chris's email or telephone number, you will receive a link within 24 hours to have this presentation available to watch, and it will also be on moneyshow.com, so you can go back on and view that in the video archive.
Yeah, and while anybody else is marked maybe typing any questions or anything like that, one last thing I wanted to touch on was just a strategic plan on like, for instance, the area that we're in. This is something where we'll drill 12 to 18 wells over our whole lease acreage, and anybody that does invest with us has first right of refusal to continue to invest with us. But the way everything works with the cyclical nature of the oil and gas business is we would prove up our concept and our play over the next 12 to 18 wells. And as oil soars back up, demand outpaces supply, we'll then put it on the market and take all of our information that we've packaged up. We'll have proven production, and then say another 25 proven undeveloped well sites to be drilled, and then we'll sell it to some individual companies that are looking for, buy some production and have some proven things to go drill. And that we've done it before. We'll probably put it on the market at about $80 a barrel or something like that, and usually that's when the crazy money comes out chasing deals, and that's kind of our concept there of what we're looking to do on a 2 to 3 year kind of time frame.
All right, thanks so much. We haven't had any questions come in at all.
No problem. Well, I appreciate everyone being on the call. Appreciate your time, Mark, and the Money Show. Thank you very much. And like I said, there's my contact information. Feel free to give us a call or email with any questions or if any information that you'd like to have from us. We thank you for your time.
Excellent. Thank you so much, Chris. Great presentation.
Appreciate it.
All right, folks. Well, again, thank you very much, Chris, for joining us today. And this concludes our live presentations for today. All the presentations will be available for on-demand viewing at the eMoney Show through August 8th and then on moneyshow.com for up to 6 months. Don't forget to log on to the eTrading Expo live October 15 to 16 to get direct online access to the world's most successful traders. You'll learn their proven strategies and techniques and discover how best to apply them in your own trading. You can review the complete schedule and register for all upcoming live webcasts at moneyshow.com. Choose the online events section from the main navigation and then upcoming live webcasts. This concludes our presentations for today. Thank you again for attending and have a wonderful evening.